That's better. So today we're talking about exchange rates. So we see that money flows between different countries. We have situations where we pay our workers in one currency, but we receive revenues in another currency, and we have this need to exchange money. And that's what we'll look at today. So first bit we have is the foreign exchange market. That is, how are we actually doing this trade of currency, and how do I figure out, well, if I have $100 and I go to Canada, how do I figure out what that's worth? Then we can look at how the value of our money can shift in the foreign exchange market. So what's going to help us? What's going to help the dollar strengthen? What will help the dollar weaken, or any currency? We have some effects of exchange rates. So how do these exchange rates actually affect our economy, or affect us as individuals, or in our economy, or whatever the case is? And then the last little bit looks at some policy that can be enacted for exchange rates. So we'll get into this, see where we go, and so on. So when we look at the exchange market, we're going to notice a few things. The first thing that we see is that, and these two things are kind of choices that countries can make. The first one is what's called dollarizing. So with this, what we're going to see is, and it can be any country using any other country's currency. Since we're in the U.S., we can do it in terms of our dollar. But this process of dollarizing is if a country that is not the U.S., or a country that is not the host country, whatever you want to say, is going to use the U.S. dollar as their currency. So we see this a lot in Central America and the Caribbean. One example in particular is Panama. And with Panama, they either directly use the U.S. dollar as their currency, or they do have a currency, but it is established by their government as being the same thing as a U.S. dollar. So we have this dollarization process. Some countries can do this, but those who don't dollarize participate in what we call the foreign exchange market, and the countries themselves don't necessarily have to, but citizens and a lot of other people do. And basically what we're doing here is I'm using one currency to buy another. So I'm going to go into the foreign exchange market, and if I'm getting ready to go to London, I'm going to go in, buy some pounds, and then go to London. Or if I'm going to Canada, I'm going to go in, buy some Canadian dollars, and then use those Canadian dollars up there. And I do have a choice in how I actually use them. So in the real world, right, I could go on my way out of the country, could buy some Canadian currency from the currency exchange at the airport, or what is becoming, I don't know if it's more popular than before, but at least one of the things that I've been able to do in international travel is have a credit card that has 0% international, that doesn't charge international fees, and then just have it be taken care of by the card directly. From what I've seen, that's the best rates you get, but maybe not. If you want to have some cash, it'd be a good idea to make that switch. But we have a choice in how we participate. But if we do go to another country, we see that. And then the big thing that we're going to see with this is what's called the exchange rate. And this is how we express currency in terms of another currency. And my notation for the exchange rate, excuse me. So when we look at exchange rates, I'm going to generally use a notation where I have an exchange rate from one currency to another. And what this will tell us is the exchange rate from dollars, that is US dollars, to, in this case, pounds. That's Great Britain pounds. And basically what this one would tell us is that 1 US dollar is equal to some number of Great Britain pounds. And same thing, the opposite, if I did it the other way around, the exchange rate from, say, pounds to dollars, this would be just the opposite of what we had up here. The exchange rate, just I'm going to flip it once I get it down. Oops. There we go. So in this case, though, the difference is that we're going to go from pounds to dollars. And again, what this one on the bottom would tell us is that 1 Great Britain pound would be equal to some amount of US dollars. Then we have, and then if we're interested just, well, where do we stand like today? And I have a little, if you're looking at the notes, I have a little table. I'm going to try and format this the way I want to. Okay. So on the left side, and if you have the notes handy, you do. If not, you don't. Not a big deal. But I have exchange rates. And these exchange rates are going to be for today, meaning right now on Google, I have the exchange rate pulled up. And on one side, we have US dollar per euro, US dollar per pound, and so on. And what this one on the left is telling us is the exchange rate from some currency to US dollar. Then the one on the right, when we say the number of euro per US dollar, and the and the pounds per US dollar. And then the one on the left here would be looking at the exchange rate from dollars to whatever currency we're looking at. So the first one that I have up is actually the pound. I'll come back to the euro in a second. But I have that if I have 1 pound, I see that the US the exchange rate right now is 1.25, meaning that 1 pound can buy me $1.25. And if I switch that over to euros, I'll see that 1 euro is going to buy me $1.09. Then to do the other side, if I have the exchange rate from US dollars per euro, to find the exchange rate from euro to US dollar, I basically just take 1 over that 1.9, and that would give me 0.92. And same thing for the pounds, I take 1 over 1.25, which would give me 0.8. So from that, what we can say is that the exchange rate, and say from dollars to pounds, will be equal to 1 over the exchange rate from pounds to dollars. So that's the main characteristic we'll see. And if we were trying to figure out, and the other thing that I like about this format is this kind of helps me figure out how do I do the math if I'm converting one to the other. So if I'm interested, say how much, or let me rephrase that, is how many US dollars is say 350 euro worth. So if I'm doing that, all I'll do is I'll take the number of euro, in this case, times the exchange rate from euro to dollar, and that'll give me the number of dollars that is worth. So in this case, I have 350 euro, so I'll plug that 350 euro into there, times our exchange rate from euro to dollar is right up here at 1.09. If I put those together, that should get me the number of dollars I have, which will work out to about $382.40 if you want to be technical. So what this is telling me is that if I'm looking at, say you're looking at an airline, you're looking at something where that's priced in euros, to pay for something that costs 350 euro, I'd have to spend $382 in order to make that exchange happen. And same thing if we said the opposite way around. So if we said how many pounds is say 700 US dollars worth, I would take my number of US dollars, multiply that by the exchange rate from, other way around, the exchange rate from dollar to pound. Then that would give me the number of pounds. In this case, I would take 700 times the exchange rate from dollar to pound we just found to be 0.8, and this will give me 560. Let's do it this way. $700, and so that would give me 560 pounds. So if I were a resident, or if I lived in the United Kingdom and I needed to buy US dollars, I know if I was looking at airfare, say I was coming to the States for vacation and I needed to go from and I wanted to take the train from Chicago to Seattle, and I saw that to get a to get a cabin in the train, or to get a room in the train, cost $700 for that long trip. So I know that $700, I need 560 pounds in order to make that purchase. So basically, this in a nutshell is our exchange rates, how they work. And if you can do both of these processes, you'll be good to go as far as making sure everything's in line and so on. And in this case today, just for future reference, today is 4/19/2020 or 4/9/2020, whatever works. So we have our exchange rates, and that's kind of how they work, the math behind it, and that's the math of this pretty much this entire chapter. So what we're interested in is we see how exchange rates work, but who's coming in and really who's coming in and participating in this market. And largely we're going to see four main groups of people, that either groups of people or firms who need to participate in the market. The first is going to be firms who are involved with international trade of goods and services. So if a firm is, so if I have a good that's made in China and sold in the US, or say it's made in Japan and sold in the US, and I'm doing that just so I get my currency straight. So if I have a good that's made in Japan, sold in the US, I'm going to receive US dollars as revenue for my product, but I have to pay my workers in Japanese yen, right? So if I am and same thing, if there's something that's made in America that gets sold in Japan, right now one of the big things going on is agriculture and farming, and they're talking about agricultural exports. Our farmers do not want to get paid in Japanese yen or anything like that, right? They want to get paid in US dollars. But similarly, the people in Japan don't want to sit and have to go and convert their yen to dollars just to go purchase something at their local market. So in between the process, the firm that takes the goods from the US to Japan is going to have to be able to deal with both types of currencies. The second one, tourists visiting other countries. If you go to another country, you have to pretty much use their currency, and different countries will act differently about this. So if you go like on a cruise to the Caribbean and you go to Mexico or Jamaica, no, they're not going to make you switch over to pesos or Jamaican currency. They'll probably just take care of your US dollars right there, especially if you're by the port or you're by the tourist part. And even if you go to Canada, if you're in a touristy part, they will, for the most part, switch your currency over and so on. But if you go to say we were sticking around Boone, or you went to almost anywhere in Iowa. For the most part, if I was walking around Iowa with a bunch of British pounds, um, probably an overwhelming majority of places wouldn't accept it. But also, Iowa is it's not really the biggest tourist destination, and it's also not really something that, maybe if I'm coming to the States from England, there might be other places I go to before I visit Iowa. So something like that. In the foreign exchange market, uh, tourists have to have the local currency in order to make purchases. Again, if I come into a restaurant around Boone or around wherever in the middle of the country, and I'm walking in with euros, they probably would be a little hesitant to accept them, if they would at all. So tourists do that. The last two are very similar, just kind of two different processes that we'll kind of see as we go through. But this first one is international investors who are buying ownership in a firm. So basically, what this is saying is our international investors um, buying stocks in other markets. So traditionally, when we think about stocks, we think about buying them from the New York Stock Exchange, right? And we go through, and generally, we if we were going to buy stocks, we go to New York Stock Exchange. But something else that I can do is I can go in and I can buy stocks from the Tokyo Exchange or from the London Exchange. But in order to purchase these stocks, and when you buy a stock, you buy ownership of the company. In order to purchase these stocks, I would need to convert my US dollars into the local currency. So, international investors, if they're buying ownership, they buy stocks. This other type is international investors who make investments that don't necessarily involve ownership. So this would be more of if we are buying um, bonds or other types of securities. So we've seen one of the things that people say, and maybe you have some from when you were a baby, but one of the things people say is, "Oh, you should go out and buy a treasury bond," right? And we have treasury bonds. You can go buy them, and they pay next to nothing in terms of interest, but they're there, they mature, and so on. So we have our treasury bonds, right? We can do the same thing with another country's bonds, right? So if Japan wants to, so whereas if um, say Des Moines wanted to build a new school, right? They could sell bonds in order to make that happen. Say, hey, we'll pay it back over X number of years. That doesn't mean that that doesn't mean you own the school district. It just means that they're doing that. Similarly, your other countries are allowed to do the same thing that we can do. In the States, they can make bonds, sell those bonds, uh, and you can receive interest or invest in those bonds in other countries. So I have these four main groups, really three groups, but four different actions. We have the firms, tourists, and international investors. And the reason they participate, again, uh, the firms have to pay costs in terms of the country with which the good was produced. Again, I personally do not want to get paid uh, in pounds sterlings or euros. I want to get paid in as an individual, like as a individual who lives in the United States of America. I want to get paid in United States dollars because that's the easiest thing to use. I don't have to get them switched over or anything like that. So, and same thing if I work in a factory or I work in a farm, I want paid in US dollars. So our costs are going to be in the country where production occurs. However, our revenues are measured by where our sales actually happen. So again, uh, if I'm going out to buy something, if we go to Walmart, and I say Walmart because Walmart has a nice selection of where their goods come from. If I go to Walmart, I don't want to say, well, I have this food from America, I have a TV from China, and I have a T-shirt from Malaysia. So I don't have to bust out three different kinds of currencies just to make this transaction happen, right? Instead, it's just I give them US dollars for the goods. They send some of those US dollars out to the wholesaler or wherever they're getting their goods from. And then the person, whoever is dealing with the international trade, gets to deal with switching the US dollars they make from revenue into whatever currency that good came from. The tourist part, I think we get the tourist part. I don't think that really needs too much of an explanation. But this last one with the financial investors, again, they can cross international boundaries, and with this, we're going to see um, two types of investments. The first is going to be called foreign direct investment, and basically what this means is I'm going into another country with the idea of either starting a firm or purchasing a firm. So with this, what we may see with foreign direct investment, I'm going to come over here really quick, FDI, and let's get a little arrow that connects those two. So with foreign direct investment, what we may see, and if you look at I'm going to pick on the automakers because this you can really see this if you look. So you have this company called Toyota of America or something like that. So Toyota of America is a subsidiary of Toyota International or Toyota, the big Toyota company, but they are a firm that's in America and they act as an American firm pretty much. And again, they are owned by, uh, so this company, Toyota of America, would be owned by Toyota. So ownership, and Toyota manages Toyota of America, so Toyota in Japan can say, hey, this is how we're running the company and so on. But they've invested in our market, and part of it is they built factories and so on. Similarly, if you look at, and I'll pick on an American as well. So if we look at, say, Ford, they also, and I may have my name slightly wrong, but oh well, they may have a company called like Ford of Asia, which is the company that would be doing all the work in Asia. And in this case, Ford Motor Company would have ownership of this subsidiary. Even though Ford would be registered in the US, Ford of Asia would maybe be registered in Japan. Toyota is a Japanese company, but Toyota of America is based in the US. They're owned by this foreign firm, or they're owned primarily by this foreign firm, but they are still based in the country that they're operating. And it's just a practice we see fairly often. But again, the idea here is that, again, I'm investing in another country with the idea that I'm going to run this firm or I'm going to actually have managerial and operate the firm. The other type of investment we see is called a portfolio investment. And this is where we invest in a country that's for financial reasons and we don't expect any management responsibility. So with portfolio investment, this would be more of, so our portfolio would be more along the lines of an individual buying shares in another market. And you can also have a firm. So fairly recently, if you've been paying any attention, you know that our stock market right now is a roller coaster, right? It'll go up today, it'll go down tomorrow, and so on. But one of the companies that people were, I guess, worried about, people were not really sure what's going to happen with the cruise lines. And one in particular that people were starting to get worried about was Carnival. Their share got down to about $8 a share, and normally they'll sell for $30, $40, $50. meaning without the bug going around. So it was down to $8 a share. But news came out that a Saudi company, a Saudi Arabian company, came in and bought like 8% of Carnival. So in this case, um, this Saudi Arabian company has no intention of actually running the cruise line, saying how to run it, or so on. They get 8% of the votes if there's a vote to be had, but they're coming in. They have no intention of actually running a cruise line. Instead, they're saying kind of like, well, the shares are $8, and we think they're going to go up, so we're going to invest and maybe capitalize fairly large on that. So again, that portfolio, we're buying shares in another market. In this case, a Saudi Arabian company is buying a decent share of Carnival. Maybe I go out and I say I want to buy some stock in, say I want to buy stock in Airbus, right? And that's a aircraft manufacturer based out of the European Union. If I wanted to do that, then I would have to go to the European market, buy shares there with euros, and call it good. So we have portfolio investment. Again, the idea is I'm not responsible for what happens with them. Now, granted, if they fold, I lose money, but I don't have to make managerial decisions and or any of those management responsibility. So, and the other part of what this portfolio investment means is, so today I came out and I bought some stock in, say, Carnival, Carnival Cruise Line. In that case, if they go and they fail, or if I buy stock today and they go bankrupt, yes, I lose my money, but nobody's going to come up to me and say, "Oh, well, you had 10 shares in Carnival and they went bankrupt," and nobody's going to sit and say that I am a bad at anything that I do because of that. You might say you took a risky choice and it didn't work out, but you're not going to question my any of the investors' managerial skills or anything like that because of a bad investment. And then a tool that we have for our I'm a little ahead of myself. Cool. So a tool that we have for when we're dealing with investments is this thing called a hedge. And this is if I have a financial transaction to kind of protect against risk. So what we can think of in our exchange market is maybe I guarantee a certain exchange rate in the future. And to do that, what I'll do is I'll say that I think that the dollar is going to be very strong in the future, and maybe you think the dollar is going to be very weak in the future. So what I might do is I might say that in a year from now, I will buy dollars at some rate in between what you and I think they'll be. And again, what this is going to do is it's going to protect me, because if the dollar doesn't go up as much as I think it will be, I become better off. But it also makes it where neither of us are really taking a huge risk in this situation. An example of hedge, or a example that we may see in our day-to-day lives, is insurance, right? So one of the things you have to, if you drive a car, you have to have auto insurance. So basically what auto insurance is a hedge against something happening that I can't afford. So if I went out today, went driving, and I'm putting extra emphasis, I caused an accident that led to somebody's death, right? If that were to happen, then let me rephrase this as excuse me. Let's not say that they died. So let's say if they got injured and they had to spend like 2 months in the hospital, right? Because this might be more expensive than death. So in this case, I have, say, $100,000 medical bill that comes up and that I'm responsible for. So if this were to happen, I'd call my insurance company, say, "Hey, I got in an accident and I caused it, and the person in the other car got really hurt and they've been in the hospital, and now I have this big bill. Since I purchased so much insurance, they would cover that hospital bill after I pay like a deductible maybe, but they would cover that hospital bill because I've paid for that insurance as a hedge against something like that happening. And again, the idea is with insurance, the idea is you're protecting yourself um, against an accident or something crazy big that would, potentially um, devastate your future. And same thing with when we think about financing, or excuse me, when we think about foreign investments, I might say that I'm going to sell something to you in the future for some rate between what you and I think it will be today. Then we're both going to be better off than then we have the potential to both be better off than what we thought we would be. So we have our hedges. So one of the things that we can do is we can invest in currencies. So this is going to come in right about here. So we want to say we invest in currencies. And we can treat this a lot. This will be very similar. It'll be a little bit slower pace than the stock market, but we can treat this very similar to like a stock market. So basically, what are we doing? What we're doing in the stock market is we have these prices listed, and we can almost treat, so in the stock market, right, we have a price, and we'll say currently Six Flags, or let's do Cedar Fair, because that one, they have a cool stock name. So Cedar Fair, who owns Cedar Point, Worlds of Fun, Valley Fair, Knott's Berry Farm, and a few amusement parks throughout the country. As of this very second, their stock price is $20.24. So what this is in essence saying is one stock of Cedar Fair is equal to $20.24. And if we wanted to say put this into that exchange rate format, we could say that the exchange rate from this stock to US dollars is 20.24. Now, if I'm investing in this stock, if that price goes up, I'm happy as can be. If the price goes down, or let me rephrase this. If I choose to invest in Cedar Fair, if the price of stock goes up, I'm happy. If the price of stock goes down, I'm not as happy. So what we can think about with our foreign currencies is the same thing. So in the currency exchange, today, I think we said that €1 is equal to $1.09. So if I as an American choose to invest in the euro, so if I choose to hold euros, then I want the exchange rate from euros to dollars to increase. And a fun little example. So suppose that I have $1,000 to invest, and I choose to invest it in euro, right? So the exchange rate from euro to US dollars today was 1.09. So we'll say that today that exchange rate is that, and say that next year this exchange rate from euro to US dollar jumps up to say 1.20. And then just for reference, just so I have them handy, this exchange rate from this first exchange rate means that from US dollars to euro would be we did this a second ago, but I'm going to get it right, would be 0.92. And the exchange rate from US dollars to euro in the future will be, I think that's 0.8, but I just want to double check. 0.83. So again, this is today and in the future. So I have my $1,000. So kind of the steps that'll go on with this. So I start with 1,000 US dollars, and the first thing I need to do is to buy my euros. So in this case, I take $1,000 times the exchange rate from dollar to euro. Excuse me, I should have done that better. There we go. So from dollars to euros, which is equal to $1,000 times today from dollar to euro is 0.92. So this means that I have 920 euros. And what I'm going to do with these euros, I'm just going to hold on to them. I'm not going to spend them. They're just going to sit in a bank account in Europe for a year. Cool. So then we wait a year. So the next year, I want to put this back into US dollars for me to make, to do what I want to do with them. So come next year, we have our 920 euros, and we need to buy our US dollars back. So we have our 920 euro. Then we need to run that by the exchange rate from euro to dollar from tomorrow or from next year. So in this case, this will work out to be 920 times 1.2. So now I have, let me see exactly what that comes out to be. 920 times 1.2. Now I have $1,104 after 1 year. Right. So in this case, what I did was I started with $1,000. I invested in euros and I just let it sit for a year. And then a year later, now I purchased back $1,100 with those euros that I had been holding on to. And again, this is just like the stock market, right? I can go in and I can buy some shares today with, I can buy some shares. No matter what happens with that exchange rate, or no matter what happens in the case of the stock market, no matter what happens with the price of the stocks, I still own X number of shares. So if I decide today to buy 10 shares of Carnival, so long as they don't go bankrupt, and same thing with the euro, so long as that currency doesn't completely collapse. In the case of Carnival, if I buy 10 shares today, whether the price goes up to $50 a share or down to $2 a share, I still own 10 shares. It's just that the value has increased or decreased. So we have this going on, and this is kind of how we can invest. Similarly, if our exchange rate were flipped, we would lose money. If it were this way, we gain money. But just a little trick we can see, and some fun we can do with investing. So some participants in this. So we've talked about who is the, I guess, the consumer of the funds, or the consumer in the foreign exchange market, right? So we have people or firms that need to, make these exchange happen. But the participant in this case is going to be those who actually switch the money for us, and we're going to call them foreign exchange dealers. And what they do is they actually go ahead and trade foreign exchanges in, they call it the interbank market, but they just trade currencies pretty much. So just like if you have a stockbroker, and your stockbroker will, or maybe you have a stockbroker online, or a stockbroker, whatever it is for stocks that you have, if you participate in that market, whatever you have for that. I personally do not go to the stock market and buy my shares, right? Instead, I have an app or I have a bank where I go through, and if I want to buy, I buy. If I want to sell, I sell. Similarly with the foreign exchange dealers, uh, odds are I'm not going to be the one going to I'm not going to go out to the United Kingdom, go to Parliament or their Department of Treasury and make that transaction happen, right? Instead, what I'm going to do is I'm going to go to one of these exchange dealers and then make that transaction happen there. In the U.S., we see a lot more throughout the rest of the world than the U.S. But if you're at an airport, you'll see this. If you're at an airport, the bigger the airport, the more likely you are to see this. But you'll see this place, and they'll have a sign up front, and it'll have a bunch of flags on it of different countries, and they'll say what the exchange rate for them, dollars to euros, dollars to pounds, and so on. And they'll trade you money right there at the airport and make that happen. Um, so again, foreign exchange dealers, they're kind of the ones that make things happen. What we will see is that most of our transactions go for portfolio investments. And the reason for this, whoops, my bad. The reason for this, 2 days ago, this Saudi Arabian company, or it may also be something to do with the state, I don't know, but this Saudi company decided to buy 8% of Carnival, which is a huge chunk of money. It's not, even if the shares were down to $1 a share, um, that would still be a lot of money. So they're coming in, and if other companies or other countries, firms are investing in a foreign market, odds are they're investing a lot of money into it, right? So I, as an individual, am not just going to go take my say I have $100 that I'm playing with the market. Um, I'm not going to take my $100 and throw it into the Japanese market. Instead, I'm probably just going to stick with our market because it's easy to do. It's not a hard process to invest in New York Stock Exchange, and it's easy. I don't have to worry about any type of tax things or anything like that. Whereas if I go to the Tokyo market, now all of a sudden I have to purchase my tax returns now become an extra $100 to file maybe or something like that. So we're going to see most of it is in portfolio investment because again, the transactions that are going to happen here are going to be large, very large transactions, like 8% of Carnival, stuff like that. Whereas if we think about myself going on vacation or tourists, and depending on who you are, if you're going on a vacation, I know that our kind of rule of thumb is we carry a couple $100 on us, or we have a couple $100 kind of tucked away somewhere when we go on vacation, just in case something happens with credit cards or whatnot. Maybe some people carry a couple thousand on them, but a couple hundred, couple thousand is nothing compared to, again, the millions of dollars that can happen in this in this portfolio investment market. So we're gonna see most of these transactions are there. And the other thing that comes up is, and we say, well, what about your labor costs, right? Because we got to pay stuff. A lot of the times, what we'll see happen on that front, I'm talking about the firms that make goods in one country but sell them in the other. These firms are able to, for a large part of what they do, they can kind of keep things local. So Toyota of America is not going to convert just all their money into Japanese currency. Instead, they're going to try and keep everything they can in US dollars. The um the the Japanese factory is going to do everything it can to kind of try and keep things in the Japanese currency. And there may be some interlap where they have to send some back and forth, but for the most part, it's not necessarily going to be the case that, oh, I go buy a $20,000 car, that's $20,000 being shipped out to Japan, right? A good chunk of that 20,000 is going to go into marketing here in the States. It's going to go towards the dealership. It's going to go towards transportation here. So that's why, again, the firms really won't be the biggest dealer or the biggest participant. It will be, it'll most likely be the portfolio investments. And again, where we see them, Let's see if we have them. Nope. So mostly seen in airports, but also in areas with a lot of international travelers. So I am more likely to come across a foreign exchange dealer in Times Square than I will in Boone, Iowa, right? Just because they have more international travelers, there's more need for an exchange of currencies. So that's where I'm most likely to see them: airports, places with a high density of international travelers. Um, Again, in other countries, you may see them more often. So in and granted, I will give credit when we were in New York, we don't really look for them that much because we have the local currency already. But when we were in London, it seemed like there were more in London than there were in New York. A reason for this could be that London has more international travelers than. Let me rephrase this. London has a higher percentage of international travelers than New York does. And as again, New York has a lot of people come from the U.S. and a lot of international, whereas London has a lot of people come internationally, but England or the United Kingdom itself isn't a huge country. And granted, it's not a small country by any stretch of the imagination, but it's not a. They don't have 300 million people living in the United Kingdom. So again, these areas with a lot of international travelers is a good place to see our exchange dealers. So our next little bit gets into what happens as our value changes. And we have two kind of things that a dollar can do. It can either become more or less valuable. So we're gonna think of this as is appreciating or strengthening. Then we have depreciating or weakening. So basically, what if our dollar gets stronger? What this means is that I am able to purchase more of a foreign currency with my dollar. So for the US dollar, this means that the exchange rate from dollars to X currency will rise. And then for depreciating, we'll see that again in terms of the US dollar, the exchange rate from a dollar to another currency will fall. That is, I can buy less currency with my $1. A big thing to note when we're talking about appreciating and depreciating is that we appreciate or depreciate against another currency. So what I'm getting at with that is this is in and of itself. And again, I'm being careful how I say this. In and of itself, this is not an indication of inflation. And that's because maybe our price level stays the same in the States, but maybe something crazy is going on overseas. Maybe something in London's going up where they're having hyperinflation, which would cause our dollar to strengthen against the pound severely. So again, if we experience something going on across all currencies, odds are we're having something going on with inflation. But if we have if just one currency gets stronger or weaker against us, there's probably something going on in just that one country. Excuse me. So that's kind of what we can expect to see. Again, dollar can get stronger or weaker against another currency. But again, it is only against another currency. So this has no indication of I can't use the exchange rate to tell you what the price of a Coke is, right? Instead, I have to look at the price of Coke in the US, look at the price of Coke elsewhere, and we'll see what's going on. So we talk about appreciation, depreciation, and we're interested in how does this affect different people? Meaning, do I want a strong US dollar or a weak US dollar? And for that, it kind of depends on who we are. So a strong US dollar means we've had kind of an overwhelming sense of appreciation, whereas a weaker US dollar is an indication of depreciation. So if I am an exporting firm, and we have the answers here, but if I am a country that's based in the US and I choose to export my goods elsewhere, what this means, and if I have a strong US dollar, let's see, how do I want to note this? With these, remember that their revenue is in the foreign currency, whereas their costs are in US dollars. And four is short for foreign. So for this US exporting firm, if the dollar becomes weaker, that foreign currency has a they're able to buy more US dollars with the foreign currency that they generated in revenue, which means they'll get to keep more profits if they have a weak US dollar. That's why for these folks, a weak US dollar is good for them, whereas a strong US dollar, not as much. The second case, a foreign firm exporting to the United States, will be just the opposite. So their revenue will be in terms of dollars, but their costs are going to be in terms of foreign currency. So again, for them, they want to bring in the most currency so that when they get back home, they can roll it back over to having the highest or the most money possible. So for these foreign firms, they like to have a strong US dollar, but are not a big fan of a weak US dollar. If I'm a tourist, I'm going to have my how do I want to phrase this? My costs are in the foreign, but my holdings, we might say, are in the dollar. So if I'm going to say I'm going to Europe tomorrow, if I'm heading out to Europe tomorrow, then currently I have U.S. currency, and U.S. currency is the only currency that I hold today, and probably for most Americans, it's probably the only currency that they hold. If I'm going to Europe, all of my costs are going to be in terms of euro, pound sterling, or whatever currency is relevant to where I'm going. So for me as a tourist, I want to take my $100, $200 and be able to get a lot of other currency for it. So for me, I like to have a strong US dollar, whereas if I have a weak US dollar, basically means that goods in the other country are going to be rather expensive for me, which isn't the best situation for me. As a foreign tourist, so if you are a foreign tourist that comes to the US, kind of just the opposite. You want your country to have the stronger dollar, so this foreign tourist does not like a strong US dollar, because that means that when they do their currency exchange, they're not going to be able to buy as much. Whereas if they have a weak US dollar, they can, when they do the currency exchange, they can buy a lot of dollars, which means they can do more on their vacation. As investors, if I am a US investor and I have invested in another currency, I do want a weak US dollar, because that's what we saw happen. And I'm going to scroll up really quick. A weak US dollar is what we saw come in with this example. So our dollar went from buying 0.92 euro to 0.83 euro, and this investor gained $104 from that switch. So as a U.S. investor, assuming my money is already abroad, I want the U.S. dollar to get weak, because that's going to help with my investments, and it's going to make it where so that when I bring my money back over, back into the States, it's going to increase, and I'm going to be in a better spot than I was from when I sent out. Whereas if I invest in other currency, then the US dollar gets strong. When I roll it back over, I'm not going to get as much value as what I put into it. So we have our US investors our US investors who invest abroad prefer a weak US dollar, and a foreign investor who wants to invest in the US would like to have a strong US dollar. And that's for the opposite reason as the US investor. So what this moves us into is how do things change in um, how can things change in the exchange market? So we can shift our demand, we can shift our supply, kind of see how things work out. The big thing that's going to cause our demand to shift and the big thing that really shifts our foreign exchanges is expectations. So if I expect that the US dollar is going to, say, become really strong over the next few months or weeks or years, I'm going to want to hold on to US currency. Or excuse me, let me rephrase that. If I expect as an American that maybe the euro is going to get really strong over the next few years, I'm going to want to go ahead and invest in euros because that's a good buy for me. I can buy them now cheap and maybe down the road sell them for a higher price. So demand of a currency is going to come because we think that a currency value is going to increase. So if we expect that exchange rate, let me rephrase this. If we expect the exchange rate from dollars to, say, pounds to increase, then demand for the dollar should rise. However, on the supply side, one of the reasons that we may experience an increase in supply is if we expect the dollar to weaken. So if the exchange rate from dollars to, say, pounds to go down, then our supply of US dollars will go up. So in this case, if I think that the dollar is about to tank, or I think something really bad is about to happen with our dollar, I'm going to go ahead and try to get rid of my dollars because I don't want to be invested in something that's about to tank in value. Just like if you're thinking about the stock market, I'm not going to go get in the stock market and say, oh, you know what, I think that such and such stock is going to fall today, so I'm going to invest in that, right? Instead, I like to try to invest in those stocks that are going to increase or that are going to, a year from now, I'm going to see gains from, not losses. So if we expect if we expect our value to increase, we have more demand for a currency. If we expect our value to decrease, we have more supply. Then it runs through a little bit of what we were just saying, and so on. So one thing that can come up, and I'm looking for our part, yada, yada, yada. We have what's called purchasing power parity. And this is a really, what I think it's a really interesting part of this chapter. So what it looks at is we have our exchange rates. But do our exchange rates necessarily indicate that we're going to have the same purchasing power just because I go with the exchange rates? And the answer will probably be no. And the reason that we might say no to this is if we just think about a US dollar, right? The dollar is different in Iowa than it is in New York City, right? That is, in Iowa, you can rent a decent place for $700 a month. In New York City, if you are trying to rent for $700 a month, good luck. So we have these differences in price levels even across our own country. So one of the things that can come up is this process called arbitrage. That is, if there is a difference between prices in countries, that is something where our exchange rate does not line up with prices of across countries, maybe I can buy a good in one country and then sell it across borders to take advantage of this difference. And with arbitrage, what we get into is we have this kind of perfect exchange rate that's called purchasing power parity. And this is going to be that exchange rate, which basically says that the prices or our purchasing power of our goods is the same across all borders. So whereas our exchange rate may be, so suppose that the exchange rate of dollars to say pounds is 1 point, or what was it? It was like 0.8. Suppose it's just 0.9 for now. So suppose that this is the case, but the price of say gas in the US is say $1.59, while the price of gas in the US, while the price of gas in the UK is say $1.49. I'm sorry, 1.49 pounds. So we can come in and we can say, well, if the price of gas is $1.59, then given our exchange rate, we would expect the price of gas in the UK to be equal to, this will come out to, let's see, there we go. So I have 1.59. My exchange rate from dollars to pounds is 0.9. So in this case, we would expect that the gas would be $1 or £1.43 in the UK, but instead it's £1.49. So when we do this, what we're going to say is that $1.59 times some exchange rate from dollars to pounds is equal to the price in the UK, which is 1.49 pounds. And with this, in this case, this, or I'm going to finish this example, then I'll get to it. So now our exchange rate from dollars to pounds will come out to be 1.49 over 1.59. And this gives us an exchange rate equal to 0.94. And with this state, or with this exchange rate, we would be considered to have purchasing power parity. At least just in our nice simple example, we're only dealing with gas. And the reason for this is, again, if the exchange rate were 0.94, I would have the same, my $1.59 when I rolled over to the UK would have the same purchasing power as it does in the United States. But again, as I kind of said a second ago, just because we're not in purchasing power parity doesn't mean we're necessarily wrong. And for that, again, we can just think about any two places, even the United States. If we were to try to move to New York, I would immediately see the price of my food would go up, my rent would go up, my car insurance would go up, right? If I moved to New York City, everything that I have, all of my costs are going to increase. So we have purchasing power parity, and it does kind of focus on what should our exchange rate be, quote unquote should. But we have this little flaw where we can, if we just think about the United States, even across the United States, we wouldn't necessarily have this. So just because we don't have purchasing power parity doesn't mean it's like, the economy is going crazy or anything like that. So two things that we'll see with this is this helps with compare international GDPs and other statistics. So the nice thing about this is it can kind of help us figure out, well, when we talk about nominal versus real values, this will give us more of a real value of output for another country rather than the rolling exchange rate. And this may also be a little more stable than the roaming exchange rate. The reason for that is if I think about like the goods across our country, for the most part, a lot of our goods don't ever really change price, right? And granted, there's things like gas, eggs, that stuff which fluctuate some, but for the most part, from day to day, a box of cereal, a oil change, something like that, they kind of stay the same price as time goes on. So when we think about this again, purchasing power parity, it just gives us a nice estimate of, how are we doing in real terms rather than just nominal terms. And the other thing that we can expect to see is that as we go through time, exchange rates will get closer to this as our time passes. And the reason for this is uh, with improvements in technology with our improvements in technology, information passes immediately, or information spreads fast, we can say, which means that if there is a difference, it will be resolved quick. Right. And with this again, I'm going to allude back to the stock market. But if you look at the stock market when an event happens, or when some major event happens, you'll see that the even excuse me, if we think look at the stock market, if a major event happens in the world, it will almost immediately react, right? Because we're in a spot where information passes quicker than ever, and you have that chance to, uh, react to something very quickly. So that's what PPP looks at. Again, over time, we expect them to get closer and closer. This is in part from our improved, I guess we can say, improved speed of getting news across the world, as well as just people figuring out that, oh, if something is really cheap somewhere, they might go to that one place to buy it, which would impact the market there, and then they go to wherever they live um, to use their good. One example of purchasing power parity that I think is interesting, and I don't think it's on the notes. No. So one example of purchasing power parity that's really interesting is this thing, or this index. It's called the Big Mac Index. And with this, what we do is we use the Big Mac and the Big Mac from McDonald's to compare purchasing power. Right. And what this is going to do, this is going to look very similar to the example that we just did with gas, kind of looked at that difference. But again, what this is going to do is this, just like we did with gas, it's going to work to explain or to show what our purchasing power should be. And what works nice with the Big Mac, and I'm going to leave a article to this if you want to go in a little more into this if I don't already have one in Blackboard. But one of the really cool things about the Big Mac, we might run into the question, why would we pick the Big Mac? Right. And the reason we'll do this is one big reason, or two, I guess two big reasons. One, it's sold throughout most of the world. Right. So it's one of the most globally recognized sandwiches in the world. And the second thing that we'll see is that it's the same everywhere. So same ingredients everywhere. So even if we think about like our different products that we have in our households, even if we think about something like pop, for most cases, uh, in the U.S., pop is largely made with corn syrup, whereas in most of the world they use sugar, right? So we have things like that where a lot of our goods that are in the U.S. versus Europe or versus across the rest of the world, we have, even though they may look similar and they maybe taste similar, they might be slightly different. There may be different things going on throughout the world. However, the Big Mac is one of the few things where no matter where you go, it's two all beef patties, special sauce, lettuce, cheese, pickle, onion, almond, sesame seed bun, right? So we have that with the Big Mac where it's the same thing throughout the world, and it makes a really nice comparison for purchasing power parity. So uh, that's kind of the gist of it. And I'm gonna post an article to Blackboard just to kind of see what's going on with it, just so that we can kind of move on for now. But I'll post an article about it, or I'll find one and get it posted to Blackboard so that you can kind of look into it more if you're interested, or you can look yourself on Google. Uh, you'll find a few interesting things about it. But it is like an actual like it's actually used by economists in the real world, which is pretty cool. So the next little bit we get into, um, kind of two last, yeah, kind of two last things that we have. First, how does the exchange rate impact our economy, and does the central bank care about exchange rates? What we see is yes. The exchange, the a central bank, so Federal Reserve um, should care about what's going on with the U.S. dollar and its exchange rate. In part because one, that's part of what makes up the value of the dollar. But a couple things that we will see is at first, if we have changes in the exchange rate, this will actually affect how much aggregate demand is in an economy. So if the dollar becomes too strong, we may see that foreign companies don't want to invest in, uh, excuse me, if the dollar becomes too strong, we may see that our companies will leave, they'll pull factories out from our country, they'll get out and go do some go somewhere else to make their goods because labor elsewhere would be cheap, even if they don't change the nominal value of that labor or the nominal price of that labor. However, on the other side, if our dollar becomes too weak, then goods that are brought in from abroad will now become like more expensive than we're used to, or they may actually just be really expensive for people. So we need to so when we think about our exchange rate, we like it to be stable, uh, and we like it to work well because if compared to what it is today, it across the board goes too high or too low, we can potentially run into some issues. And again, the big across the board thing here is that we want to look across the board. I don't necessarily care what happens with just one other country. Instead, I'm interested in what happens among all countries. So we're looking for more of a trending, not just one individual country that happens to have a substantial fluctuation. And the second thing again is with these fluctuations, if the exchange rate is so if our exchange rate is just jumping up and down like uh kind of crazy, like it's unstable, it doesn't give a nice stable picture of what's going on with exchange rates, and we don't like that. The Federal Reserve really likes to see that stability. They like everything to be calm, normal, and so on. So to help keep exchange rates where they need to be. Right now, we kind of talked about the stuff with that. So to kind of keep exchange rates in check, we have a couple different types of policies um, that we have a couple different types of policies that uh, countries can enact. And these are going, and at first we're looking at more the philosophical side, then we'll close out with a couple examples that we use in the States. So we have these four categories. The first is called a floating exchange rate. And this is one where the exchange market determines the rates. So this floating exchange rate is a lot like a free market currency exchange. So if the dollar gets stronger, it gets stronger, great. If it gets weak, it gets weak, great. A lot of people, sometimes people will say that the U.S. and a lot of your how do I want to put it? U.S., Europe, a lot of your quote unquote free countries will have this floating exchange rate. However, I would go to more say that we have what's called this soft peg or soft exchange rate pegs. And what this will do is, and we have two soft and hard peg, hard exchange rate pegs. And what these do is they're different levels of intervention in the exchange rates. So with the soft peg exchange rate, we'll see that normally the market is determining our exchange rate, but if things get a little too crazy one way or the other, our central bank may intervene. Right? So soft peg again, it's just saying, hey, we're going to let it do its thing, but again, if things go too crazy, we're going to intervene. Just like if we think about our market, or at least how our market is supposed to be in the U.S. Right before the virus started going around, everything was kind of calm. Everyone was it was good times. Everything was calm. Everyone was doing their thing and so on. But then the virus kind of came in and disrupted that, and kind of, for lack of a better phrase, we closed our economy. Right. So when we close our economy, it kind of put everything to a halt. The downside of this is there are people who aren't getting paid. So in the case, and this isn't monetary policy or exchange rate, but what happened with us is the government intervened and threw some money into the system to kind of keep people from going broke. Same thing here. If the exchange rates are too high or too low, the central bank can intervene and either work to pull them up or pull them down by messing with the interest rates and supply of money. The hard exchange rate pegs is going to be where the central bank is actively intervening and really works to keep the currency fixed at a very certain level. So this is a very hands-on approach. Our examples of a uh, hard exchange rate will be something like China, or countries that are more of our large government countries, if we want to say that. Then at the very end, we have what's called merging currencies. That is, the currency is set to be the same thing as in other countries. So this would be at the very start of today, we talked about dollarization. That's basically what this is, right? We dollarize our currency and we make it the same thing as in other currencies. Now, when we do this, I'll get into that really quick. So when we do this, the disadvantage of this merging currency, right? There's an advantage and disadvantage. The advantage is that you don't have to worry about monetary policy. That is, it's something, it's just, I don't have to worry about it. The disadvantage is I don't have to worry about monetary policy. So disadvantage is if I'm, say, Panama, and I choose to dollarize with the US dollar, or I merge currencies with the dollar, I'm at the mercy of the Federal Reserve of the United States. So if something's going on in our country, I may not have the same flexibility that I would if I had my own currency. So that's what we see with the merged currency. Again, any country that dollarizes has that merged currency. And this kind of goes through every one of the things that we looked at: soft peg, hard peg, and a merged currency. So the last little bit for this unit is, what are some tools that we can actually use? What are some tools and taxes that we can have? So as money flows across, we're talking about international capital flows. Again, that's capital that goes across national boundaries. It can be either portfolio or direct investment. One of the things that we can do is we can say that we want to maybe reduce these capital flows. And this is something we see with the U.S., and we actually do these. So we have these things called Tobin taxes, and what we'll do with these, we have taxes on these international capital flows. So if you've ever flown into the country, or you've driven in or brought up, if you've ever left the country, then come back. Um, One of the questions that customs asks, whether they physically ask you or it's on the little form that you fill out when you come in, one thing they ask you is, are you carrying more than $10,000 of currency on you? And if you are, you're supposed to report that because you have to pay a tax on it. Or you have to pay on the tax on the currency over $10,000 because again, we don't want to we don't want large sums of money going into or out of the country because that's you know could potentially lead to instability. So again, so we have these Tobin taxes, and the goal is again to reduce these international capital flows, so that we don't have large movement in exchange rates, which can kind of shake up the economy. So again, large these large movements in capital flows we don't really care for that much. However, there is a challenge with this because um, it's kind of difficult because you can't necessarily just say, well, you have to pay a tax on what's going on outside of the country. That is, national governments, how do I put it? The European Union cannot levy a tax on islands, right? Because they are another entity. They are not able to come in the United States and say, "Hey, you have to pay a tax to our cause." Or Germany cannot tax islands, right? Because they have to. They're a different country and they don't really have a say in what we do. So what makes this hard is um, if I do if I do come back into the country with currency, if I don't report it, it's very easy to just say no, I don't have it, and just move on with your day. But also, it's hard if I decide to take money out of the country, um, and say I take money out, I put it in a Swiss bank account. If Switzerland doesn't tell the United States what I have going on, the United States is never going to figure it out, right? Or technically, they'll never be able to figure it out because they can't access that Swiss bank account. So again, it's a really nice idea where yeah, we want to lower these capital flows so that we don't have uh, so that our so that we don't have a roller coaster with exchange rates. But it's difficult because again, the United States only has sovereignty over the United States. Switzerland has it over Switzerland, and nobody else can. The United States, if Switzerland would let them, they could, but in general, the U.S. can't just go to Switzerland and say, "Hey, show us what you have going on." And if they don't want to, they don't have to open up what's going on. So that's what we're looking at. We're looking at capital flows and exchange rates. Like I said, I'll get that article posted to Blackboard, and that should work for you. As always, if you need anything, feel free, let me know. Have a good weekend. Be smart, be safe, all that good stuff.